Hello champs, hope you all are doing amazing. So in this video, let's revise the most important chapter from the exam point of view, that is your partnership accounts, which totally has 6 units. From the exam point of view, this definitely fetches a good weightage, that is you can expect at least 15 to 20 marks being raised in this particular chapter, totally over 6 units guys. Let's give our best effort in securing that marks. With the same spirit, let's begin the session. So, unit number 1, which is Introduction to Partnership Accounts, consists of some basic fundamentals about how the partnership firm operates and few basic calculations with respect to preparation of profit and loss appropriation, calculation of interest on drawings, capital, those things is what we are going to understand. So let's do it one by one. Also, we will look at some important questions along. So first, to understand what is and how partnership firm operates, and a small overview about limited liability partnership as well, because the chapter name here is partnership and LLP accounts, because both works on the same principles and the same concepts holds relevant. Yes. So first of all, partnership. The partnership here will be regulated by the Indian Partnership Act 1932. As per that act, which is where we understand the definition, which is defined in section number 4, what it says is partnership means a relation between persons who have agreed to share the profit of a business carried on by all or any of them acting for all. This is just repeated. You can just hide this. So there is one important line which we need to focus here on is carried on by all or any of them acting for all. This is basically a representing point wherein if there is a partnership firm, there is at least minimum 2 persons required to constitute a partnership firm. Basically, what this line means here is if any one partner representing a firm takes any decision, it will also be binding the other one. So, therefore, it is carried on by all or any of them acting for all. Next point, the agreement. This is basically focused on sharing profits and mutual agency. That is, whatever points is being agreed upon will also be relevant or will also be considered on behalf of the other partners. Operation. Every partner is an agent of the firm and the other partners. So what does the word agent here represents? It basically means that whatever act is being represented as performed by firm will also be binding on the other partner. So here, when a partner is considered as an agent of the firm, it becomes very important with respect to application of the decision taken on whole basis. So this particular line, whatever you observe with respect to definition and the agency, you can sometimes see this coming up in true or false also. Please make sure that you have got a proper clarity on these points. So one particular disadvantage is what you can consider comparing this with limited liability partnership form of organization is partnership as per the act, it comes with unlimited liability. What does unlimited liability means? If the partner's respective assets which is available in the business is not sufficient with respect to repayment of liability, there is no restriction as such that they cannot use the personal assets of partners. So unlimited liability can also go up to the extent until it gets settled to the partner's personal assets also. See, that is what is represented here. There is a business debt, not partner's personal debt. There is a business debt. But if the business assets of the partner falls short with respect to repayment, there is no restriction that they cannot use the personal assets of partners. Therefore, the personal assets of the partners are at risk. This entire structure, what we understood is with respect to Partnership Act. Now let's also understand limited liability partnership. Then we will observe the common points between both. Now limited liability partnership is regulated by Limited Liability Partnership Act 2008. So there is a definition which is given in section 2. What it says is a partnership formed and registered under this act. Basically, it is a partnership arrangement. What is partnership? We have an idea. So in this structure, what is the main rule book or the objective here is it there should be a written agreement. This is very important, which determines mutual rights and duties of partners and their relationship to the LLP. So basically what it enhances here is there should be a clear points mentioned with respect to what is the role, what is the responsibility played by each and every partner, and how does the contribution works towards the LLP. Next, with respect to this particular arrangement, that is what is the advantage of limited liability? There is a protection which avails with respect to personal assets. So, what is the difference between unlimited and limited liability here is if there is a liability with respect to a partnership firm, that is business liability, partners will only be limited to the business assets and there will not be any additional right as you saw in the normal partnership with respect to personal assets. So therefore, there is a extension which is levied with respect to liability here. Personal assets are protected, so there will be no hindrances as we observe that in the normal partnership. Then, one more advantage what we can observe here is the LLP acts as a separate legal entity. The LLP is distinct from its partners. So basically there is a differentiation which we can observe, that is owners are, that is partners are completely separate entity and the LLP altogether, the organization is an other entity. Whereas in partnership you don't observe that because you also saw there was a point of agency. Now, this is a structure what we understood with respect to partnership and LLP. Some common points to consider here is with respect to registration. For partnership firm, it is purely optional. There is no mandatory to register. Whereas under LLP, the registration is a must. So there is mandatory registration. You cannot operate a limited liability partnership without registration. Second point, coming to liability, as we saw, normal partnership has unlimited liability and LLP has a limited liability. With respect to legal status, that is how can it be understood in the legal consequences, same entity as partners, that is there is uniformity with respect to the identity, there is no distinction between partners or the firm, whereas under LLP there will be a separate legal entity. With respect to agency, partners act for each other, that is if one partner has taken any decision, that decision should be by default all applicable or relevant to the remaining partners. Whereas under LLP, partners act for the LLP. They are not responsible for the other partners. They are only responsible for the contract which exists between them and the LLP. Then in traditional partnership, a team of people acting as one because they completely represent the whole partnership firm. Whereas in LLP, it is a legal container protecting the people inside it. How does it protect? Points which we saw, which gives a separate advantage, is with respect to limited liability and the separate identity structure. This definitely gives that extra verging point to decide to operate with respect to normal partnership. So this entire thing just gives you an overview about partnership and limited liability partnership. Moving ahead, there is this topic in your study material, that is difference between ordinary partnership firm and an LLP. Just now whatever points we discussed will also hold good as your differentiating point. If you have understood few, that would be enough for you to recall the points if this is tested in the exam. So let's also observe the additional points here. What is the applicable law? We just understood for partnership it is Indian Partnership Act, whereas for LLP it will be Limited Liability Partnership Act 2008. Registration for a normal partnership firm is optional, whereas for LLP it is mandatory. And creation, this is created by an agreement, whereas LLP is created by law. So this is connected to your registration point. Body corporate, it is not a body corporate, that is partnership firm is not a body corporate, whereas LLP is a body corporate. What does body corporate mean here? It is nothing but an entity registered or incorporated by a foreign country or a foreign law. So, in short, you can just understand this body corporate as an entity which can enter into a partnership arrangement. Whereas in partnership, it is not at all a body corporate. LLP is a body corporate. So, basically, it just obtains a corporate structure with partnership arrangement. Next, separate legal entity. There is no separate legal entity for a partnership firm, whereas for LLP, there is a separate legal entity. Perpetual succession. This is a point which we generally observe with respect to companies. What does perpetual succession means? It just runs forever. Partnership does not have such perpetual succession because as per Indian Partnership Act, the business itself would have been constituted with a particular purpose. So therefore, they do not entertain this point. Whereas under LLP, it has perpetual succession and individual partners may join or leave, but its existence continues forever because we just understood the point of separate legal entity. Next, when it comes to number of partners under normal partnership, minimum 2, maximum 50, whereas under LLP, there is only minimum criteria mentioned, that is 2, but there is no maximum limit. When it comes to liability of each partner is unlimited. It can be extended up to the personal assets of the partners. Whereas under LLP, liability of each partner is limited to the extent to agreed contribution, except in case of willful fraud. Now, what does this mean is liability is first of all limited. And this is limited until what? Until their agreed contribution. That is how much ever they have considered that this is what my liability extent is, until that proportion it will be taken. If in case of willful fraud, that is any objective of doing it intentionally, then this point will not be considered because the objective here was to intentionally perform a fraud. So therefore, the limited liability point cannot be made use of in a misuse way. That is, you cannot consider it for your advantage is what this point means. Next, designated partner. Designated partner, if you want to understand in a better way, this is just like board of directors for a company. Designated partners for a limited liability partnership is nothing but the role players, the person who is majorly responsible to conduct or to take any major business decisions. So for normal partnership, there is no such provision, whereas under LLP, at least two designated partners and at least one of them shall be resident in India. This is the minimum criteria which is specified as per LLP Act. So minimum anyway there are two partners. If there are just two partners in LLP, two of them should mandatorily act as designated partners. And there is one more conditions attached which says at least one of them should be resident in India. Next, legal compliance. All partners are responsible for all the compliances and penalties under the Act. Here, they cannot blame. I am not liable to whatever has happened. If the judgment or the decision taken by the firm is not in a favorable way amongst all partners, everyone would be held responsible. Whereas under LLP, only designated partners are responsible for all the compliances and penalties. Because as I mentioned, they are the one who will be responsible to run the business. So when it comes to compliances and penalties which arises due to some default from the people who run the business, so this again should have been considered by them itself. Foreign partnership. Foreign nationals cannot become a partner in a partnership firm because the law restricts this purely. Whereas under LLP, foreign nationals can become a partner in a limited liability partnership. This gives that advantage when there operates a foreign collaborations. The foreign partner can also become a partner in an LLP. Foreign nationals is what is talking about individuals. This foreign partnership can become a partner in an LLP basically means is if there is any foreign entity, they can also attach themselves as one of the partner. For example, assume there is ABC LLP, and if there is XYZ LLC. LLC means a entity incorporated in a foreign country. So that particular XYZ LLC can just act as one of the partners in ABC LLP. Clear with this? Yes. Next, minor as partner. Under Indian Partnership Act, minor can be admitted to the benefits of the partnership with the prior consent of the existing partners. Here, the status with respect to minor is only specialized with respect to benefits, and this is only acceptable provided there is consent obtained of the existing partners. Whereas under LLP, minor cannot be admitted to the benefits of LLP. There is complete no with respect to LLP. These are some points which can give you a differentiation between normal partnership and a limited liability partnership. Hope you got a clarity on whatever points we just went through. Then next comes partnership deed. Under that, some main clauses in a partnership deed. Partnership deed is nothing but a written agreement which is done by partners mutually, which includes all of the points which has to be conducted, which has to be incorporated in the course of the business which is commenced. Yes, the relation between the partners is governed by mutual agreement known as partnership deed. This is nothing but mutually discussed and done. It should be comprehensive to avoid disputes later on. This just gives acts as your legal document to just refer in order to, if there are any confusions, in order to operate, or what are the points which we are going to look, you will understand that better. It is usual, therefore, to find the following clauses in a partnership deed which may or may not be registered, because we just understood that registration was optional. Yes. So what are the few clauses which we can observe in a partnership deed would be name of the firm and the partners. That is name of the firm along with the name of partners. Commencement and duration of business. When is the business, partnership business commenced, and duration. Some businesses works on a seasonal basis. Therefore, it also mentions about duration. Remember, on top, just we saw about the point of perpetual succession. It was not relevant for a normal partnership. That is why duration is also given here. Then amount of capital to be contributed by each partner, how much they are ready to invest, and then amount to be allowed to each partner as drawings and the timings of such drawings. So drawings is nothing but use money invested which is withdrawn by partners for their personal purpose. Now this can also be written in the partnership deed, that is how much can they withdraw and what are the intervals when they can actually withdraw it. Next, rate of interest to be allowed to each partner on his capital, on his loan to the firm, and to be charged on his drawings. So there are three things here: rate of interest on capital, rate of interest on drawings, and rate of interest on loan which is given to the firm. So this interest should also be mentioned, because ultimately when the calculation is done, the main thing where we refer to would be in the partnership deed. Next, the ratio in which profits or losses are to be shared. That is, what is the proportion? How can they divide the profits and losses? Whether a partner will be allowed to draw any salary. First, the point should be mentioned here, whether there is any provision that the partner can draw salary. Then only a partner will have that right to draw a salary. Then any variations in the mutual rights and duties of partners. If there arises any situation where the agreed rights or duties need to be variated, so that point should also be taken care here. Method of valuing goodwill on occasion of changes in the constitution of the firm. With respect to treatment of goodwill, we have a separate unit altogether. More discussion on this point in that particular unit. Then procedure by which a partner may retire and the method of payment of his dues. In partnership, there is also an activity of retirement. If that is relevant to partners, what is the way to retire and the method of payment of his dues? Basis of the determination of executors of a deceased partner and the method of payment. This happens on when there is a death of a partner. That is, on what basis should we identify the executors? That point needs to be mentioned. And then what is the method of payment in order to settle the due of deceased partner? Then treatment of losses arising out of insolvency of a partner, because ultimately when it comes to partnership firm, there should be also a point considering the other partners. What if one partner turns out to be insolvent? Then procedure to be allowed for settlement of disputes among the partners. If there are any dispute which arises, what is the dispute resolution mechanism which needs to be brought in? So that is also need to be taken care. Then preparation of accounts and their audit. That is preparation of accounts of a partnership firm and getting it audited. All of these points are suggestive in nature in order to incorporate in a partnership deed, which is relevant to a particular partnership firm. Those points can be incorporated. There is one more point which is important. What it says is registration of the firm is not compulsory. We already understood that. But what is the disadvantage if you're not registering? Non-registration restricts the partners or the firm from taking any legal action, because obviously from the point of view of legal status, if you observe, it does not at all hold valid if you do not have that registration as a picture to present in front of legal system, that is court or any adjudication authority. Often there is no written partnership deed, or if there is one, it may be silent on a particular point. This is with respect to registration. In that case, the relevant sections of the Partnership Act will apply. If on any point the partnership deed contains a clause, that is whatever we saw, it will hold good. Otherwise, the provisions of the Act relating to the questions will apply. Now, what does this point mean here is, if a partnership deed specifies a particular point, that point will hold good. If by chance there is no written deed, or if the partnership deed is silent on a particular point, then there are some arrangements provided as per the Partnership Act that will still be relevant. Next point. This is an important theory question. Direct 5 marks or 4 marks you can expect if a theory question is framed. They can either test you on a direct theory points which is needs to be addressed, or they can also frame it in a case law situation. How is that given? We will understand. First, let's understand the points here. These are the points which needs to be considered if there is no partnership deed at all. Where is it given? This is as per the Partnership Act. So if there is no partnership deed, what are the basic points need to be taken care? In the absence of any agreement to the contrary, no partner will have right to a salary. That is, no partner can draw salary because there is no deed mentioned. Next, no interest is to be allowed on capital. There is no rate of interest which can be considered here. Then no interest is to be charged on the drawings. There is no interest on capital, no interest on drawings. Next point is again connected to interest. Interest at the rate of 6% per annum. Now this is with respect to what is to be allowed on partner's loan to the firm. If there is any loan granted by partner to the partnership firm, in the case where there is no partnership deed present, you only have supposed to take 6% as the rate of interest. That's what this point means. And profits and losses are to be shared equally. So there are totally 5 pointers which we need to consider. 3 points are related to interest. What are those? There is no interest on capital. There is no interest on drawings. If there is a loan advanced by partner to the firm, rate of interest is only 6% per annum. These were the 3 points related to interest. The other 2 points is, one, partner cannot draw salary, and the last point where profits and losses are to be shared equally. Now here I had mentioned they can also test you in the form of a case study. How does it be framed? They will just give you all the points what the partners are expecting. Sometimes they can tell you, for example, assume there are two partners A and B, and there is no partnership deed present in the partnership business. Now B wants to draw salary, something like that. So in this case, there is a strict no, because In the case of absence of partnership deed, these rules are must to be followed. So B will not be entitled to draw any salary. Sometimes they'll also give you cases where you get confused. Interest on loan is given. So that is, partner has given loan to the firm. Now interest on such loan is demanded by the partner at 10% per annum. Is that possible? Can they obtain such a rate of interest? No, because the act itself is clearly specifying you can only take 6% if there is no partnership deed. Understand one thing clearly, this is relevant only when there is no partnership deed. If there is a written partnership deed, then obviously we will follow what points are mentioned in partnership deed. Is this clear? Yes. So next, profit and loss appropriation account. Now this is an extension of your profit and loss account. Whatever we have discussed in final accounts will still be relevant. Just the nature here changes. There it was a sole proprietor. Here we will understand from a partnership business point of view. So every business will definitely have to find out their results. That is ultimately whether they've made profit or loss. So in my profit and loss account, I will understand the structure. That is whether we have made profit or loss. Now, additionally to that, there are partners in the business. If you remember, after profit and loss account, where we got net profit or net loss, we were directly adding it to where capital of a sole proprietor. Yes or no in the balance sheet. But now what happens? There is no only one person. There it was just a sole proprietor. So it was easy to completely give away the profit or loss. Now, in partnership business, what happens? There will be some transactions which is happening between firm and partner. So before we ultimately take it to the balance sheet, it becomes important to allocate that profit for so many purposes, which is resulting due to transactions between firm and partners. Some examples could be partner's salary, that is partner who's acting as an employee with respect to firm. The partnership firm has to pay salary. Other points which can come is the partner has made some drawings on which the firm has is entitled to charge interest. And one more point is there is capital invested by the partners. So firm can also charge interest on the same. So these are nothing but the transactions happening between firm and partners. So before we ultimately show this profit in the balance sheet, it becomes important to also apportion or appropriate the profit with respect to such partnerships transaction. So this is effected in a separate account called as profit and loss appropriation account. So what is need to be understood here? See, during the course of business, a partnership firm will prepare trading P&L at the end of every year. The final accounts of a sole proprietorship will not differ from the accounts of a partnership firm. That's what I mentioned you about. The profit and loss account will show the profit earned by the firm or loss suffered by it. This profit or loss has to be transferred to the capital accounts of partners according to the terms of the partnership deed. Why terms of partnership deed? Because there we will understand their profit sharing proportion. And according to the Indian Partnership Act, if there is no partnership deed or if the deed is silent on a particular point, if there is no partnership deed, what did we just see? It will be shared equally. Yes. In a partnership, profit has to be divided between the partners in a certain profit sharing ratio after making necessary adjustments stated in the partnership deed, such as with respect to interest on capital, interest on drawings, and interest on loans, and if there is any salary or commission to partners, etc. These are some impacts of arrangements which we see between partners and partnership firm. Accordingly, an additional account is prepared and net profit is transferred from the debit side of the P&L account to the credit side of this new account. Because if you imagine a profit and loss account, when there is a situation of arriving at net profit, it will be shown on the debit side. So how do we start with profit and loss appropriation? This will be first taken open forward and then we will bring down that net profit and accordingly make the adjustments, which is called profit and loss appropriation. And before the profit is divided between partners, it is necessary to record above stated adjustments in this account. So when it comes to the format, it will have the same format as we have understood with profit and loss account. After we understand everything point by point, you will also observe the format of profit and loss account and how the relevant items are recorded. Now, the student here can observe that if a salary is to be allowed to a partner, the profit and loss appropriation will be debited and partner's capital account will be credited. What is the logic behind this? See, profit and loss appropriation, as I told, is working on the same nature as profit and loss account does. In profit and loss account, what were we doing? We were debiting all expenses or losses and crediting all incomes or gains. So salary, think from a partnership firm's point of view. What is partner's salary to the firm? It is an expense. So we will record it on the debit side of P&L appropriation. Now, thinking from partners' point of view, represented as partners' capital account. Now, capital account will always have a credit balance. If the partner's balance increases, what should we do? We should have to credit it. So, therefore, partner's capital account will be credited. Similarly, if interest is to be allowed on capital, now understand one thing, capital is invested by the partners to the firm. Correct. Now, since the firm has to repay it, firm will record this as a liability. Now, think from partners' point of view, they have made an investment. For them, it would be an asset. Now, we are recording all these transactions from the partnership firm's point of view. Now, when the interest is demanded by the partners, partnership firm has to pay interest on capital. So, for a firm, it becomes an expense. So, therefore, again, profit and loss appropriation will be debited and the respective capital accounts will be credited because for them, it is nothing but interest income. That is income on investment they have made. So, therefore, it will be credited. No entry will be made for partners' drawings in profit and loss appropriation because profit and loss appropriation just records those items which is in the nature of income or expense to the firm. Drawings is nothing but completely taking a part from the investment made by the partner. So that will not be impacted in P&L appropriation. Whereas interest on drawings is an income to the firm. So that will be recorded in profit and loss appropriation account. I hope you got an overview about profit and loss appropriation account. So let's discuss more of this in detail. So before we get into the actual steps one by one, that is interest on capital, interest on drawings, interest on loan or other things, we have to first get a proper clarity what items will appear. So for that, we will understand one small point, which is charge against profit and appropriation of profit. Now, what does charge against profit means? Profit and loss account. So here, expense will be provided even if there is loss. See, when we are presenting a profit and loss account, we will not observe whether we will be ending it at net profit or net loss. So anyway, it belongs to the current year. We will have to record it. We will have to charge it to profit and loss account. Some examples here could be your rent and salary. Whereas in P&L appropriation, because P&L appropriation account, what it specifies is expense will be provided only when profit is available. So whatever expenses we just understood, we just discussed, these will be provided only if there is sufficient profit available, because anyway this is connected to partners, this is not a business expense. So what they decide here on is if the profit is available we will appropriate, if it is not available then it is not possible, unlike charge against profit. So some examples for this is interest on partners capital and partners salary, but there is one exception to this. All the items provided to partner is appropriation of profit except rent to partner and interest on partner's loan. Why there is these two exceptions is, understand one thing or think logically. If I'm taking something on rent from a partner, or if I'm taking something on rent from an outsider, anyway this has to be borne. So we have to just think from an opportunity cost point of view. Just because I've taken it from partner, I cannot take it for granted that rent can be paid or might not be paid. You have to just think, if I had taken it from an outsider, shouldn't I have to incur this expense? Because this again becomes like similar to charge. So therefore, rent to partner is not an exception to this, and interest on partner's loan. Similarly, if I had borrowed loan from any outsider or a bank, I would have anyway paid interest. Since it is taken from partner, I cannot disobey this. So therefore, these two becomes an exception. So these are not considered as appropriation of profit. This will still be a charge against profit, and we will record this at profit and loss account itself. I hope this point is clear to all of you. Now, profit and loss account, this is just explaining you the chain effect, how it works. See, in profit and loss account, we arrive at net profit. How is that arrived? After reducing all expenses which are in the nature of charge against profit. Now, you should be familiar between what is charge against profit and now what is appropriation of profit. It should be distributed among partners as per the agreement. So this distribution calculation can be observed in profit and loss appropriation account. So your first step here would be transfer of net profit from profit and loss account to profit and loss appropriation account. The format will be same particulars amount. So from P&L we have net profit. This will be transferred to P&L appropriation. When it is taken in profit and loss account, we would write there as net profit carried down. Since it is not directly taken to balance sheet, so we will first bring it to P&L appropriation. So this will be written as net profit brought down. Is this clear? So this is the first step to open profit and loss appropriation account. Now we will understand one by one each particular item which has its place in P&L appropriation. So first item under this is interest on drawings. First, to understand on what type of drawings will interest be considered. Drawings can be understood in two forms: drawings against capital or drawings against profits. What is drawings against capital means? It is partner's own investment which is being withdrawn from the business, partnership business. So, with respect to partner's capital, we cannot question why are you drawing it. So, therefore, the firm has no right or share to calculate interest on this. So, there will be no interest on drawings if it is against capital. There is one more category which is called drawings against profits. So now what is this drawings against profits? See, there is a partnership firm which conducts business. So after they are running the business, they will arrive at profit. So this will be a profit belonging to the entire partnership firm. If any of the partner draws anything from this profit proportion, that is considered as drawings against profit, and that is for a personal purpose. So in this case, this will be out of the business, that is entire partnership business as a whole. So on this particular drawings, we will charge interest. Now, how to decide what is given in the question? See, if only drawings is mentioned, it will be drawings against profit. That is how we understand. It will not be considered as drawings against capital. If that is the consideration, the question will make a clear highlight or whether it would be proper in communicating, since we need to charge interest on such drawings. Yes, partner will give or pay interest. To whom? To the partnership firm. Understand the logic. So capital was invested by the partner. Now drawings is made from the entire partnership business's profit. So this was belonging to partnership firm. So partner is drawing. On this drawing, the firm will have a right to charge interest until this is paid back. So think from the partnership firm's point of view, this will become income of the partnership firm. That is what is given here. It will be income for a partnership firm and expense for partner individually. So we are only concerned from the point of view of partnership firm. So if it is an income, we will record it on the credit side of which account? Profit and loss appropriation account. Is this clear? Yes. So we first understood on what drawings we need to charge interest. Now to calculate interest, there are three methods as per your syllabus. So let's understand that one by one. First, there is a simple method. As the name itself says, it just works on a simple calculation of interest. See, let's work out this example. Mr. Hay has drawn following amounts. Interest is given as 12% per annum. These are the dates of drawing and amounts of drawing available. Now, how to calculate interest if it is a simple method? On 1st of June, you have drawn 10,000. So 10,000 is drawn, rate of interest is given at 12% per annum. So amount of drawings into rate of interest into number of months it is outstanding. So from 1st of June until year end, that is how we calculate interest. So June, July, August, September, October, November, December, Jan, Feb and March. So from 1st of June until 31st of March, there is totally 10 months due. So that is what is considered into 10 by 12. So if you solve this, we get 1000 as the interest amount. Next, the date of drawing is 1st of December. Amount is 7,000. So 7,000 into 12 by 100 into 1st December until 31st March. So December, Jan, Feb and March. So 4 months. So if you solve, we get 280 rupees. Next drawing is made on 31st March itself. Amount is 5,000. So since it is done on the year end, so we cannot charge any interest. So there will be no interest. Total interest which is due would be 1,280. That is 1,000 plus 280. So this is how we calculate if it is as per simple method. While reading the question, if nothing mentioned in the question, we will simply follow this approach itself. Clear? Yes. So next method is product method. So as we saw in simple method, we directly applied percentage and then number of months. So under product method, we will just calculate first the amount of drawings with number of months, that will be called as product. We will first find out total product and then use this formula total product into rate by 100 into 1 by 12. If you observe, there is just 1 by 12 taken. Why? Because while we calculate total product itself, the month's criteria would already be taken care there. So how is it done? Let's understand. See, first we will record the amount of drawings and then number of months. That is like we did under simple method from 1st June to 31st March. How many months? It was 10 months. So that is what I have written in months. In the second installment, 7,000 it was outstanding for how many months? 4 months. That is 1st December to 31st March. 4. So 5,000 was drawn on 31st March itself. So there will be no months due. So first we need to find out total product. How do we do this? 10,000 into 10, that is 1 lakh. 7,000 into 4, 28,000. Last installment, there is no interest. So total product here is 1,28,000. Understand one thing guys, here we just found total product, but we actually want what? Interest on drawings under total product method. So 1,28,000, rate of interest was same 12% like we saw in the previous example and into 1 by 12. So this is how we solve under product method. If you observe, under both the methods the interest amount is same. Just as a matter of practice, we have taken one question here. Let's solve this. So amount of drawings is 500. 29th February 2022. So now in this case, let's consider 31st December as your year end. 31st December as the year end. Taking this as a criteria, let's find out the number of months. 29th February is the ending date of that particular month. So remaining, how many months are there? March, April, May, June, July, August, September, October, November and December. So totally there are 10 months. How do we find the product? Amount of drawings into number of months. So this will be 5,000. Next, 400 on 31st of March. So I will be left with April to December, April, May, June, July, August, September, October, November and December. So there are totally 9 months. So 400 into 9. So this will be 3,600. Next 600 on 30th June. So remaining months from July to December. So I'll be left with 7 months. So 600 into 7. 4,200. 800 on 31st October. Remaining months, November and December, 2 months. So 800 into 2 will be 1,600. What is my total product? 5,000 plus 3,600 plus 4,200 plus 1,600. This is 14,400. So interest on drawings will be 14,400. Let's assume the rate of interest same as 12% into 1 by 12. So this will be into 12% divided by 12, which is 144. 12% divided by 12, 144 will be your interest on drawings under product method. I hope this is clear. So in this calculations, what becomes mainly important is when is the date of drawing and when is the year end. So based on that, we will calculate number of months, multiply that with amount of drawings, and then find out the total product into rate of interest into 1 by 12. Clear? We have understood two methods. Last method here is average period method. This method will have some identification point, that is how can we consider to apply this method would be relevant to calculate interest is we'll observe a pattern that there will be drawings made on regular intervals. So there will be regular drawing amount at equal intervals. So if this is the pattern what we can observe, the most suitable method to consider interest would be average period method. So first, in order to understand this, we need to find out average period. How do we arrive at this? You take time left after first drawing plus time left after last drawing, that is final amount whenever you're drawing in that particular accounting period, divide that by 2. So this division by 2 will indicate that on what average period basis we can consider. So after we find out average period, interest on drawings formula will be total drawings, that is how much ever you have drawn in that particular year, into rate by 100 into average period divided by 12. We understood how to find out the average period. For example, every month, first drawing 10,000 uniformly. That means, for example, if I have to take from first of April, and then 1st of May, 1st of June. So likewise, they have borrowed 10,000 every month. So in this case, how to find out average period? Time left after first drawing. After first drawing, that means after 1st of April, how many more time I have left? Hence, I had drawn it anyway on first day of April itself. So, have the whole month of April and then the following month. So, totally I have still 12 months until 31st March. Yes or no? So, time left after first drawing will be 12 months plus time left after last drawing. Time left after last drawing. So last drawing would have happened in the month of March, that is 1st of March. So left after last drawing is I still have whole of March. So 1 month, 12 plus 1 divided by 2. So this is my average period. So if I do 12 plus 1 divided by 2, I get how much? 6.5. So what is the formula? Total drawings into rate by 100 into average period divided by 12. Total drawings 10,000 every month. So there will be 10,000 into 12. This gives us the total drawings into rate of interest. Let's understand here to be 6% into 6 by 100 into average period divided by 12, which is 6.5 divided by 12. So this gives us interest on drawings as 3,900. Is this clear to all of you? Yes? Next. Now, this is a small table which gives you a summary of what period the drawing should be done and what could be your average period, instead of sitting and calculating the entire thing, that is time left after first drawing plus time left after last drawing divided by 2. If you're drawing at the beginning of every month, that is like we understood in the example, first of every month. So if it is monthly, that is you have to calculate interest on drawings monthly, your average period will be 6.5. How do we do this? We understood 12 plus 1 divided by 2. If it is quarterly, then you will take 12 plus 3 divided by 2, because one quarter means 3 months. So that is what is considered here. Time left after first drawing. The drawings would have been done first of every quarter. So then it will be 12 plus 3 divided by 2. Half yearly, that is for whole 6 months. You would have drawn on 1st April for first 6 months. So time left after first drawing will be 12 entirely. Time left after last drawing will be 6 remaining, because once in 6 months you draw divided by 2. Likewise, if it is drawn in the middle of the period, assume 15th of every month. So then we will take just 12 by 2, 12 by 2 and 12 by 2. See, this works on a concept of if it is beginning, n plus 1 by 2. If it is middle, then it is n by 2. N here represents your time period. If it is end, you take n minus 1 by 2. So how is it? Same, depending upon whatever we understood. Time left after first drawing, that is time left after last drawing divided by 2. Same logic. This is what is understood. 12 minus 1 by 2, end of the month. For example, assume you're drawing every end of the month, 30th April, 31st May, likewise. So in that case, time left after first drawing, you're drawing on 31st April, you're drawing on 30th April. So we will leave the month of April. How many months remaining here? So how many months will be remaining? Just 11. That's why it is 12 minus 1 by 2. So likewise for half yearly, likewise for quarterly, just the variation changes. If it is monthly, 1, if it is quarterly, 3, if it is half yearly, 6. Understand this table so this becomes simpler if you're solving a question which incorporates such points beginning, middle or end. Yes, if date of drawings is not given, we should consider it as middle because date ultimately becomes important for our judgment. And period will be 6 months. If it is middle, we will normally consider as a average period and hence it becomes 6 months. So this is about 3 methods of interest on drawings, that is simple method, product method and average period method. So we will understand this more in detail while we take up the questions. Moving on to next point, partners capital account. Now this becomes important to understand with respect to interest on partners capital. Partners capital account as per the Partnership Act can be maintained in 2 methods. One is fixed method, one more is fluctuating method. What is fixed method? As the name itself says, the capital balance with respect to the investment made will be fixed in nature. Only those transactions like additional capital invested or any capital withdrawn will only be reflected in the capital balances. All other transactions like with respect to partners, salary, drawings or interest on capital or drawings, everything will be impacted by preparing a separate account called as current account. So this is as per fixed capital method. There is other method, fluctuating method. As the name itself says, every transaction will be impacted to the capital balances. So everything will be reflected in the capital account itself. So if nothing mentioned about which method in the question, if there is no mention about any particular situation, we will understand this to be the following fluctuating method and record all the transactions in the capital account itself. If the question specifies the capital is maintained as per fixed method, then all the transactions apart from capital additional introduction or withdrawal will have to be recorded in a separate account called as partners current account. Clear? Yes. So we just understood this criteria in order to understand interest on capital. This is step number 3. So first of all, to provide interest on capital, if you remember, we also observed the point in clauses of partnership deed. It should be mentioned in order to charge this interest. Agreement, and that too, it should be written agreement. If it is an oral agreement, again, it will not be relevant to consider interest. Appropriation of profit. This is a nature of appropriation of profit. You will provide this only when profit is available. This is calculated on capital balances because this is interest on capital. If fixed method used, then this will be recorded in current account. What will be recorded? The transaction with respect to interest on capital will be recorded in current account. Whereas the differences of additional capital or withdrawal of capital will be still recorded in partner's capital account itself. How to calculate this? So we will have to consider the structure, opening capital, additional capital and withdrawal of capital. Understand one thing, I just want you to alert one thing here. They might also confuse you giving drawings in between. until and unless they don't mention anything, what do we consider with respect to drawings? It will be against profit. It has no connection with respect to withdrawal of capital. So here we need to be very careful in order to calculate capital balances, which becomes impact figure for calculating interest on the same. So let's understand this with one example. Opening capital, which is the balance as on 1st of April 2025, is 1 lakh. There is an additional capital, means which is introduced in between the year, that happened on 31st of May, 50,000. And there is withdrawal of capital. So there is a clear mention the capital is withdrawn on 31st of October, 10,000. Then there is drawings on 1st Feb, 5,000. So what are we calculating? Interest on capital. Does drawings matter to us here? No. So this will not at all be taken with respect to calculating capital balance. Now, how do we consider this? So here comes a concept of effective capital employed. So what is the effective capital employed? It is a capital which consider with respect to for how many duration this amount is present in the business. Depending upon that, we will charge the respective interest. How is it done? Let's understand here. See, first we will open with 1 lakh. This 1 lakh as a balance is present in the business for how many months? So next capital was introduced on which date? It was on 31st of May. That means from 1st April until 31st of May, the balance was just 1 lakh. So when the capital changes until there, the balance was 1 lakh. So I will take 1 lakh into 2 divided by 12. Out of total 12 months, for 2 months, the balance is 1 lakh. That's what it means. Rate of interest is given as 12%. So that is how we have mentioned here. 1 lakh into 12 by 100 into 2 by 12. This was interest only for 2 months. We have to calculate the interest for the entire year. Plus, the capital was introduced. So this was on 31st of May. Then we have to check the subsequent date until when the balance, that is 1 lakh plus 50,000, is present in the business. If you observe on 31st of October, there is withdrawal. So until then, that is from 1st of June until 31st of October, the balance is still holding good, correct? So from 1st of June, the balance now turns to be 1 lakh and 50,000 until 31st of October. Means how many months? May is done, June, July, August, September, and then it is 31st of October. So October will also be considered. So there is 5 months where the balance will be at 1 lakh 50. So it is 1 lakh 50,000 into 12 by 100 into 5 by 12. So this is nothing but we are considering for how many months the balance is present in the business. Plus, after 31st October, there was a withdrawal. So the balance changed to 1 lakh 40,000 because 10,000 was withdrawn. This was present in the business for how long? Remember, we are ignoring drawings because until and unless it is specified, we will assume it to be drawings against profit. So there is no impact with respect to that here. So 1,40,000 is present in the business until the year end. So this is happening on 31st of October. That means November, December, Jan, Feb and March. For how many more months? Again for 5 months. So this will be 1,50,000 into 12 by 100 into 5 by 12. So if you observe, we have just considered the balances which was present in the business for irrespective of number of months and then finding out the interest. So if we calculate this, our interest on capital will be 16,500. Whatever we did is named as effective capital employed method. The calculation, whatever we did with respect to how many months such capital balances will be available, is called as effective capital employed. That is, 1 lakh will be employed in the business for 2 months, 1 lakh 50 will be employed in the business for 5 months, 1 lakh 40 will be employed in the business for another 5 months. So how will we calculate interest on capital? Effective capital employed into rate by 100, that's what we did, into 12 by 100 into 1 by 12. So in other words, I can just solve it like this. Effective capital employed using the same above example. What I can do is 1 lakh was present in the business for how many months? 2 months. 1 lakh 50 was present in my business for 5 months. 1 lakh 40 for 5. So we will calculate this. This calculation is called as effective capital employed. As per the formula, effective capital employed into rate by 100, which is 12 by 100 into 1 by 12. So same answer we get again 16,500. See, it is the same approach. What we have done here is we have just taken the common things out, because number of months divided by 12 represented as 1 by 12. Anyway, we will multiply the number in order to find the effective capital employed. I hope you understood the structure. Whenever the question specifies capital ratio, this is very important, especially tested by ICAI. They will focus on effective capital employed method itself. It might be mentioned clearly in the question, if it might not. So when it is informing you that capital ratio, it is very important that you solve it as per this approach, that is effective capital employed method. Is this clear? Yes, if nothing specified, we will solve it on the simple method basis like normal interest calculation. One more point to consider here is net loss and interest on capital. Subject to contract between the partners, interest on capital is to be provided out of profits only, because it is an appropriation of profit. In case of loss, no interest is provided. Yes, we are aware of it. But in case of insufficient profit, there could be a situation where profit is there, but it is not enough. Then what can we do? That is, net profit is less than the amount of interest on capital. The amount of profit is to be distributed in the ratio of capital. Ratio of capital here means on effective capital, as partners get profit by way of interest on capital only. Now, what does this mean? Let's understand this with an example. See, net profit available is 5,000. There is interest on capital for A directly given, interest on capital for B directly given. Now, if I have to observe, what is the total? 3,500 plus 2,800. The total interest requirement is 6,300. How much is net profit available? It is just 5,000. So, net profit here is not sufficient with respect to interest on capital. In this case, what does the provision specify here is we will apportion the available profits in proportion of their ratio of capital. Now, when you are given interest on capital, this is nothing but interest charged on the capital balance is provided, yes or no? So if this is available to us, don't you think we can find out what is the capital ratio? How can we find out? See, 3,500, that is for A, and 2,800 for B. You have to just find out a common number which gets divided. If I cancel 0 and 0, both would be divisible by number 7. So this is 7 5s are 35 and 7 4s are 28. So this is nothing but my capital ratio, which I will use to apportion the available profit. So net profit available is 5,000. So for A, 5,000 into 5, which is his share, out of the total share 9. For B, it will be 5,000, which is available net profit, divided by into 4, which is his share of total share, which is 9. So 5,000 into 5 by 9, this will be 2,778. I've just rounded it off. 5,000 into 4 by 9, this will be 2, 2, 2 and 2. This will be their proportion to take this 5,000, since the profit was not sufficient enough to provide for total interest on capital. So this is the step which we need to use when profits are insufficient to provide for appropriations. One example what we observed here was for interest on capital. Clear with this? Yes. Next point to understand, guarantee of minimum profit. Now, what does this guarantee of minimum profit provide us? There is a partner sometimes who is incoming, where the remaining partners would guarantee them. So this is the minimum assured profit you get irrespective of what is the total firm's profit. So that is nothing but the guarantee given by partners. So this guarantee can be agreed on the mutual ratio basis, that is what all the partners decide on, or there can also be a consideration of agreed ratio, where the firm specifies on what basis you need to take away this guarantee. So how is it done? Let's understand. See, the firm's profit is earned year end if actual partner's share is less than guaranteed minimum. If it is yes, then the point comes of deficiency. How is the deficiency taken care? Before that, first let's understand. No, there is no problem. Whatever share is given from the profit distribution, that is enough with respect to the guaranteed amount. Allocation will be done in a normal way. That is, for example, assume the firm has made a profit of 10,000. So in this 10,000, there are three partners. They are apportioning it in the proportion of 3 is to 2 is to 1. Assume the guarantee is for Mr. B. A, B, C are three partners. The guarantee is for Mr. B. And Mr. B is assured of some amount. While this 10,000 was apportioned between 3 is to 2 is to 1, whatever share was received by B was with respect to the guaranteed profit. So this is the case where allocation is done in a normal way. Partner retains actual share that is higher than guaranteed, then there is no problem. If there is a deficiency, now first let's understand there are three partners A, B, and C. Assume 10,000 is the profit share of the firm. They will allocate this in the ratio of 3 is to 2 is to 1. So for A, it will be 5,000. For B, 10,000 into 2 divided by 6. Then for C, 10,000 divided by 6, 1667. Now assume for Mr. B, the profit which was promised was 3,000. If you observe from the calculation, B is anyway getting a share of 3,333. So the minimum assured was 3,000. So there is no problem with respect to deficiency. This is what the first category means. It is allocated in a normal way. Now, if there is a case of deficiency, what does deficiency means? Assume, for example, the guarantee given by Mr. B was 1,000. So in this case, instead of B getting 3,333, assume B is just getting 2,500. So there was a guarantee which was assured for 3,000. There is a shortfall. This shortfall is called as deficiency. Now there is a deficiency which arises. What is this deficiency? Guaranteed profit minus the actual share. What was the guaranteed profit? 3,000. But what is the actual share they are getting? 2,500. So deficiency here will be 500. The partner receives guaranteed minimum amount. The partner should anyway receive the guaranteed amount. Who will bear this guaranteed amount? Some modes will be provided to you in the question. It is payable by one remaining partner. If there are only two partners, the other partner will bear the guarantee. So individual guarantee. If it is payable by at least two or all, that is whosoever is remaining in the business, an agreed ratio. The guarantee of deficiency will be specified in the agreed ratio that will be given to you in the question. So that will be considered with respect to apportionment. Payable by remaining partners in mutual profit sharing ratio. There is no such ratio given. Whatever profit sharing ratio they were sharing profits or losses equally, the remaining partners will make sure they will consider this guaranteed amount. Now, what does this mean? For example, assume there were just two partners. Deficiency amount is 500 here. So the entire 500 will be paid by other partner. Second case, all in agreed ratio. Assume the agreed ratio is 1 is to 1. So there are three partners. B will have to be given with guaranteed profit. So there are remaining A and C who will share it in the agreed ratio, which is 1 is to 1. That becomes 250 and 250 each. Next case, in the mutual profit sharing ratio, there was A and C, their remaining ratio was 3 is to 1 because they were sharing profits and losses in the ratio of 3 is to 2 is to 1. So B is the person who is supposed to take 2. That's why we have taken 3 is to 1. So this 500 will be apportioned in this ratio 3 by 4 and 1 by 4. So this is called mutual profit sharing ratio. Let's understand with an example. Assume there is 3 is to 2 is to 1 as the ratio. C is guaranteed with 30,000. Total profit is 1,20,000. This is the total profit of the firm. First, we will calculate normal proportion. So 1,20,000 into 3 by 6 will be 60,000 for A, and 1,20,000 into 2 by 6 will be 40,000 for B, and 1,20,000 into 1 by 6 will be 20,000 for C. If you go back to the question, C was guaranteed with 30,000 as the profit. But C, as per the distribution, is just getting 20,000. What is the deficiency? 10,000. Now, this 10,000 can be bared depending upon how the details of guarantee is assured on the question. So in this case, remaining partners is taking. So there is nothing mentioned, there's no agreed ratio. So we will go with the question, whatever their proportion of profit sharing was there. So 10,000 is the deficiency, 10,000 into 3 by 5. So A will pay 6,000 and the balance 4,000 by B. How will this be done? A has got how much? 60,000. In 60,000, if he gives away 6,000, the balance distribution will be 54 for A. Similarly, to B, 40,000 was his apportionment. In that, 4,000 is given. So, 36,000 for B. C had got 20 plus 6 from A and 4 from B. Total 30,000, which was the guaranteed profit is provided to C. I hope this guarantee of profit to a partner concept you have understood how to calculate. You will get more clarity while we solve a question on this. Next point, partner's commission. This again is an appropriation of profit. When partner also plays an employee role in the firm, this point comes into consideration. How to calculate? It depends on what details are given in the question. If you remember, we had also understood manager's commission in a final accounts chapter. The same points again comes here. That is before charging commission, after charging commission. Let's understand how this is done. So this is an appropriation of profit. That means we will provide only if profit is available. Let's take an example. There is a net profit of 1,10,000. Interest on capital of A is 10,000 and interest on capital of B is 12,000. So total interest is 22,000. There is salary of A 6,000, salary of B 5,000, total salary expense 11,000. A is entitled to 10% commission on net profit. Observe the wordings, 10% commission on net profit. If it is just normal net profit, what was the net profit? 1,10,000. On that, 10% we charge. So 11,000 will be A's commission, who was also a partner. Next case, what it says, A is entitled to 10% commission on net profit, but this is not just net profit. After charging such commission, after charging is the word which you need to observe. If that is mentioned, you will take net profit, but observe here, instead of taking just rate by 100, we will take rate by 100 plus rate. So what was the rate of interest? 10. So 100 plus 10 is 110. So this is how we calculate. If it is after charging mentioned, after charging could be salary, could be interest on capital, any wordings given. So if that is the case, you will take rate divided by 100 plus rate. Is this clear to each one of you? Yes. So that's what is mentioned here. Next. To make this clear, let's understand this example. Commission of net profit after charging interest on capital and salary. We were given with interest on capital and salary balances. Net profit was 1,10,000 minus 22,000 minus 11,000, because the question clearly mentions after charging. So we will subtract this from net profit into, since it is after charging, rate divided by 100 plus rate. So this is, which is 10% after charging commission, 10 divided by 110, which is 7,000. This is a format for your profit and loss appropriation account. That is, whatever points we discussed till now, this is how it will be presented. As step 1 we saw, net profit will be carried down in P&L. We will first bring it forward here by net profit brought down. This is how we open the account. Then you consider all the points in the form of nominal account from the firm's point of view. Whatever is expense to the firm will be shown on the debit side. Whatever is income to the firm will be shown on the credit side. Interest on capital is an expense to the firm because we are giving away interest for the investment made by partners. So therefore, it will be debited. How to calculate? We have already understood. Then paying partners salary. This is also an expense which is recorded as two partners salary. Then if there is any partners commission, two partners commission. Then sometimes the question gives you transfer some percentage of profits to general reserve. So this reserve again belongs to partners itself. Therefore, we consider this to be appropriation again. So that will also be considered here. Then interest on drawings. This is with respect to the drawings interest paid by the partner to the firm. So this becomes in the nature of income to the firm. So shown on the credit side. So after calculating all of these, if we have any profits left, you will again be considering with either profit if the balance is appearing on the debit side or if there is a loss. So anything that is profit or loss will have to be again transferred to the partners in what ratio? We will transfer this in old profit sharing ratio, which is given to us in the question. If nothing mentioned, we will share it equally, because rules in the absence of partnership deed, we anyway understood that if nothing is present, we will have to share it equally. I hope these points are clear. This is the format of profit and loss appropriation account. Now, after we understood all of the things, let's solve questions to practice whatever concepts we have discussed so far. First, A and B formed a partnership with capital contribution of 50,000 and 30,000 respectively on 1st Jan. Now here date becomes very important to observe the capital balances. The profits were to be shared in the capital ratio. Observe this very carefully. They are clearly mentioning that the sharing of profits, which profit, what you get in profit and loss appropriation should be done in the capital ratio. Capital ratio means what? Those calculated on effective capital basis. Calculate the capital ratio on the basis of following details and interest on capital. There is capital ratio asked. Interest on capital if the rate of interest is 6% per annum. Whenever you come across such questions, remember for interest on capital, there was no such method. There was only one thing, effective capital employed method. So capital ratio means also we will have to find out the ratio based on the capital found out on effective capital basis. So if we follow one approach, we will be able to answer for both, that is capital ratio as well as interest on capital. So let's first do it for A. They started business on 1st January. Next, if you observe, there is details given of capital introduced, that is additional capital introduced and capital withdrawn. So observing the dates, we will have to understand the balances. For partner A, we will first find out effective capital. Now we started with the balance of 50,000 that was on 1st Jan. Observe this 50,000 was present in the business until what date? If you observe, the next entry is happening on 31st of March. So this 31st of March, until then the balance is 50,000. So Jan, Feb and March. So 50,000 for 3 months. Then the balance is increased because there was a capital introduction. This balance is increased as on 31st of March. Then we have to see until when this balance is there, until 1st of July. So April, May and June, 3 months, 50,000 plus 5,000. So the capital balance is now 55,000 for how many months? April, May, June, because the next is happening on 1st of July itself. 3 months plus. On 1st of July, if you observe for A, we are first doing it for A. There is a withdrawal of capital 3,000. Now understand one thing, this is present in the business until when this balance, that is from 55, if I draw 3,000, the balance is 52, present until when? 1st of September. So that is how many more months? July, August, because the next introduction is happening on 1st of September. So there is 2 months. 55,000 was the last balance. There is a capital withdrawal. So the remaining balance will be 52,000. This is for 2 months plus. From 52, there was capital introduction. 5,500. So 52,000 plus 5,500 will be 57,500. This is present in the business until what date? 1st of November. So September, October, 2 more months. 57,500 into 2 months plus on 1st of November, there is a withdrawal. There is a withdrawal 4,500. See, when they are telling you the balances was on 1st January, do you think we will end it on March? No, we will end it on December itself. So then there was last installment, there was a withdrawal from 57,500 minus 4,500. So we are left with 53,000. This is until how many months? November and December. 2 more months. To just have a clarity, you can just tally these months. If it is for a period of 12 months, it just verifies that you have done it right. 3 plus 3 plus 2 plus 2 plus 2. So this is totally 12 months covered. Now let's find the effective capital. 50,000 into 3, this will be 1,50,000 plus 55,000 into 3, 1,65,000 plus 52,000 into 2, 1,04,000 plus 57,500 into 2, 1,15,000 plus 53,000 into 2, 1,06,000. So this in total will be 1,15,000, 1,04,000 plus 1,65,000, 1,50,000, 6,40,000. What is this called? Effective capital. We will next do in the same way for B. Effective capital. B started with a balance of 30,000. This was for how many months? For B, the next transaction is on 31st March. So Jan, Feb and March. So this is for 3 months. So on 31st March, there is withdrawal of capital. So the balance started was 30,000 minus 2,000. This is 28,000. Next transaction is happening on 1st of July. So from April to July, April, May, June, 3 months. So in July, what is happening? There is capital introduced for B. Last balance was 28,000 plus 9,000 introduced. So this will be 37,000 for how many months? July to September. July, August, 2 months. What is happening on September? There is withdrawal for B. So last balance was 37,000, 1,000 withdrawn. So 36,000 into how many months? From 1st September to November, September, October, 2 months plus. Last installment, what is happening for B? There is capital introduced. Last balance was 36. So it plus 4,000 means 40,000 into how many months? 1st November. So November and December, 2 months. Let's find out the effective capital. 30,000 into 3, 90,000 plus 28,000 into 3, 84,000 plus 37,000 into 2, 74,000 plus 36,000 into 2, 72,000 plus 40,000 into 2, 80,000. This in total will be 74 plus 84 plus 94, 4 lakh. So the question is asking us capital ratio and then interest on capital. First, capital ratio. A is to B. For A, 6,40,000 and for B, 4 lakh. So if you have to further simplify, I can cancel out the ratio, find out the common number which I can divide by 640 I can use 8 as the common number. So 80 and then 50. So your capital ratio, if I cancel out zeros, will be 8:5. Then interest on capital. For A, anyway, we have calculated effective capital 6,40,000 into rate by 100 into 1 by 12. What was the rate given? 6%. 6 by 100 into 1 by 12. So 6,40,000 into 6% divided by 12. 6% divided by 12. So this will be 3,200 for A. And for B, effective capital was 4 lakh into 6% into 1 by 12. 4 lakh into 6% divided by 12. This will be 2,000. So rate of interest, interest on capital for A is 3,200 and for B is 2,000. Is the calculation clear to all of you? Yes. Next question. A and B are partners sharing profits and losses in the ratio of their effective capital, just like what we saw now. They had 1 lakh and 60,000 respectively in their capital accounts as on 1st of Jan. They are giving us the opening balance. A introduced a further capital of 10,000 on 1st April 2022 and another 5,000 on 1st July 2022. On 30th September 2022, A withdrew 40,000. On 1st July, B introduced further capital. The partner drew the following amounts in anticipation of profit. What does this mean? They have given drawings against profit. So they have given the drawings detail and then they are mentioning rate of interest into 12% per annum interest on capital and 10% per annum interest on drawings. Date of closing is given as 31st December. This becomes very important to calculate the capital balances as well as rate of interest. Calculate what? First, profit sharing ratio, that is based on capital, then interest on capital and interest on drawings. So like we did in the previous question, we will have to first calculate effective capital. First for partner A, effective capital. They had 1 lakh. 1 lakh was on 1st of Jan. 1 lakh was present in the business until when? Introduced a further capital of 10,000 on 1st April. So Jan, Feb, March. So 1 lakh is present for how many months? 3 months. Next, 10,000 was added. So the balance became 1,10,000. This was present until 1st of July. So April, May and June. So 1,10,000 for 3 more months. And another 5,000 on 1st July. Until 1st July, this was continuing for 30th September. So July, August and September. So the balance was now 1,15,000 into 3 months. Then on 30th September, A withdrew 40,000. So this was present in the business until 31st December. So October, November and December. 1,15,000 was last balance. So there was a withdrawal of 40,000. So the balance is now 75,000. This was for how many months? 3 months. So totally, if you see, there are total 12 months covered. So what is the effective capital? 1 lakh into 3. 1,10,000 into 3. 3,30,000 plus 1,15,000 into 3. 3,45,000 plus 75,000 into 3. This will be 2,25,000. 45, 3,30,000 plus 3 lakh. This will be 12 lakh. Similarly for B, effective capital. B on 1st July, we introduced further capital of 30,000. So from 1st of Jan, his balance was 60,000 that was present up till 30th June. So Jan, Feb, March, April, May and June. 6 months, 60,000. Further, what happened? We introduced further capital of 30,000. So from 60,000 it went to 90,000. This was from 1st July to December. July, August, September, October, November and December. So 90,000 into 6 months. This will be 60,000 into 6, 3,60,000 plus 90,000 into 6, 5,40,000. 3 lakh 60, this will be totally 9 lakh. Now we have got the effective capital. What is the requirement of question? First, to calculate profit sharing ratio based on effective capital. So profit sharing ratio. This is like the previous question what we did. A, B. A's effective capital is 12 lakh and B 9 lakh. So if I cancel out zeros, 5 zeros, this will be multiplied by 3. 3 fours are 12 and 3 threes are 9. So the profit sharing ratio will be 4:3. Then they are asking us interest on capital. Interest on capital for A. What is the rate of interest given? 12% per annum. Interest on capital is allowable. So effective capital, that is 12 lakh into 12 by 100 into 1 by 12. This will be 12 lakh into 12% divided by 12, 12,000. And for B, 9 lakh into 12% into 1 by 12. So 9 lakh into 12% divided by 12, this will be 9,000. So these are interest on capital of A and B. And then last they have asked interest on drawings. For this, have they mentioned any method in the question? What have they given? A drew 1,000 per month at the end of each month beginning from Jan. B drew 1,000 on 30th June and 5,000 on 30th September. 12% is interest on capital, 10% is interest on drawings. By reading, you should be able to connect to the points what we observed. A drew 1,000 per month at the end of each month beginning from Jan. Don't you think this wordings is uniform amount drawn at regular equal intervals? So which method? Average period method. So what was the formula there? Total drawings into rate by 100 into average period divided by 12. So for A, average period method, total drawings, they are drawing it at the beginning from Jan. So there are total 12 months which is drawn even though it is end of each month. So 1,000 into 12. This is total drawings into rate by 100. What is interest on drawings rate given? 10%. 10 by 100 into average period divided by 12. Here they have mentioned this is end of each month. Remember n minus 1 by 2. So this is for whole of the period 12 minus 1 by 2. So this will be 5.5 divided by 12. Average period divided by 12. So 1,000 into 12. This is 12,000 into 10 by 100 into 5.5 divided by 12. 10% into 5.5 divided by 12. This will be 550. Clear with this, all of you? Next, for B, simple average method because nothing is mentioned. They have just given the date of drawings. So for B, 1000 is on 30th June and 5000 on 30th September. 1000 on 30th June. From 30th June until 31st December, how many months are left? So July to December. So it will be July, August, September, October, November, December. 6 months. Rate is 10% into 6 by 12 plus 5000 on 30th September. So balance months is October, November and December. 5000 into 10% into 3 by 12. So this will be 1000 into 10% into 6 by 12 plus 5000 into 10% into 3 by 12, 125. So this in total will be 175. Hope you all understood the question, that is to calculate profit sharing ratio. Remember, they had emphasized on effective capital. We first found out effective capital. Then based on that, we found out the ratio. Interest on capital was also done as per effective capital employed method. And then interest on drawings by identifying how the requirement of drawings is given. Next. A, B and C entered into partnership on 1st April 2021 to share profits and losses in the ratio of 5:3. So here they are giving us the profit sharing ratio. 5:3:2. A personally guaranteed that C's share of profit after charging, this is after charging interest on capital at 5% per annum, would not be less than 30,000 in any year. So basically, there is a guarantee given for partner C that his profit will not be anything less than 30,000. Capitals of A and B, A, B and C were 3 lakh 20, 2 lakh and 1 lakh 60. Profits for the year ending 31st March before providing for interest on partners' capital was 1 lakh 59. So understand this point carefully. This is where most of the students miss out on. Before providing interest on capital, we want the same value because this is nothing but appropriation, interest on capital. We will have to first bring down the profit and then provide interest on capital. Yes. So that is why this is what is required to us. So let's prepare profit and loss appropriation account. Profit and loss appropriation account for the year ended 31st March 22. So first, bringing down the net profit. By net profit brought down, how much is given? 1,59,000. The question says there is interest on capital. First, we need to provide this and then apportion the profit. To interest on capital, because this is an expense to the partnership firm. To interest on capital, there are 3 partners. A, they have given the capital balances. Use your calculators. For A, 3,20,000 into what is the rate of interest given? 5%. So this will be 16,000 for A. For B, B's capital here is 2 lakh into 5%, that is 10,000. And for C, 1,60,000 into 5%, this is 8,000. So in total, we will get 34,000 as interest on capital. After we subtract this is called as divisible profit. So 1,59,000 minus 34,000. So profit available is 1,25,000 to divide. When the guarantee of profit concept is there, first of all, you have to check whether the profit distributed was within the guarantee or not. That is what we will do to partners capital account, because ultimately this profit will be shared to partners and will be transferred to partners capital. A 1,25,000. What is his profit sharing ratio? 5:3:2. That means 5 plus 3, 8 plus 2, 10. 1,25,000 into 5 by 10. That will be 62,500 for A. For B, 1,25,000 into 3 by 10. This is 37,500 for B. And for C, 1,25,000 into 1 by 10. Sorry. 1,25,000 into 2 by 10. That will be 25,000 for C. Now, what is the guaranteed profit for C? 30,000. And this is guaranteed by whom? Partner A. But how much is apportioned in the normal appropriation of profit? 25,000. So there is a deficiency of how much? 5,000. Since only A is ready to bear the deficiency, we will take out the share from A. So 62,500 minus deficiency to be shared to C. How much is required? 5,000. So 5,000 will be reduced from A's share. 62,500 minus 5,000 is 57,500, which will be ultimately transferred to A's capital. For B's capital, 37,500. He's not sharing any guarantee. For C, add received from A, which is 5,000. So the net amount which goes to C's capital will be 30,000. So the actual amount will be transferred to partner's capital will be 57,500 for A, 37,500 for B and 30,000 for C. This is how the guarantee will be disclosed. So total of P&L appropriation will be 1,59,000. I hope you guys understood the concept of guarantee of minimum profit by a partner. Moving on to the next question. This is a very important and interesting question wherein they have given you the concepts of whatever we have discussed so far, plus there is rectification problem also involved. Let's read. Weak, able and lazy are in partnership sharing profits and losses in the ratio of 2:1:1. It is agreed that interest on capital will be allowed at 10% per annum and interest on drawings will be charged at 8% per annum. No interest will be charged or allowed on current accounts. There is current account balances like we give on capital. There is no such point for interest on current account. The following are the particulars of capital drawings of the partner. When you are observing current account, this also informs us of one of the situations that the partners are maintaining their capital balances on fixed basis. That's why there is current account balance given. Next, the draft accounts for 2022. Draft means what? It is still not finalized. Showed a net profit of 60,000 before taking into account interest on capital and drawings and subject to following rectification of errors. See, till now in whatever question we saw, there was net profit before providing for partnership related adjustments. So here also there is partnership related adjustments, that is interest on capital and interest on drawings. But along with that, there is also one point which says subject to following rectification of errors. That means first what we have to do, there are some transactions which has errors. We need to rectify it, consider the impact it might have on the profit and then take the corrected profit for all of these calculations. So first point, life insurance premium of week amounting to 750 paid by the firm on 30th June 2022 has been charged to miscellaneous expenditure account. There is an error. Life insurance premium is nothing but a personal expense of partner week. This has been charged to miscellaneous expenditure account. So first impact, we need to rectify this. Let's write this in the working note. Rectifying entry. Likewise, we can also consider impact on profit because they have mentioned this is as per draft. So first, There is a personal expense which has been charged to miscellaneous expenditure. We need to reverse this. What should have been the rectification entry? Drawings of week debit to miscellaneous expenditure. This is the rectifying entry. I'm directly telling you the rectifying entry. Drawings, because this is in the nature life insurance premium personal expense, drawings account debit to miscellaneous expenditure account. Now understand with a simple logic, those which reduces the expense on the other side increases our profit, yes or no? From the profit and loss account, we are getting a net profit of 60,000. This is anyway arrived, but there was an error which is involved. Now, after rectifying, this also need to impact my correct profit. So now what happens here? Miscellaneous expenditure, which would have been debited, has impacted in the amount of 60. Now this effect is reversed. So when the expense has come down, what will it have an impact on profit? My profit will increase. So there will be increase in profit. Increase by how much? Increase by rupees 750. Now this is impact which we have taken for rectification. Understand one thing, this was in the nature of drawings. In the question, they have also given us drawings. Yes or no? They have given us the drawing details of week. So this 750 will also be added to week's drawing. This is important not to be missed. Next point. Repairs of machinery amounting to 10,000 has been debited to plant account and depreciation thereon charged at 20%. Repairs of machinery has been debited to plant account. So first of all, repairs is a revenue expenditure. They have treated it as a capital expenditure. That needs to be reversed. So first we will understand that. So repairs which is debited to plant is not correct. Repairs need to be separately recorded as a revenue expense. So we will debit repairs account. What is debited to plant need to be eliminated. So we will have to reverse. That means we will credit plant account. This is understood. Now, what the question specifies is there was a depreciation on this also charged. If you have taken this 10,000 as part of a plant, you would have also charged depreciation on the same. So, what is the depreciation percentage given? 20%. So, on 10,000, depreciation was also charged, which is actually not correct because anyway, this is treated as repairs, which is not subject to depreciation. So, depreciation should also be eliminated. Yes or no? When depreciation was created, the entry would have been depreciation account debit to plant account. We have to now reverse this. So what will be the entry? Plant account debit to depreciation account. Repairs amount was 10,000. On 10,000, 20%. So 2,000 and 2,000. Now we need to consider the impact on profit. Repairs is your expenditure. Since it was shown as an asset, now the expense, revenue expense is increased. So increase of expense means your profit will come down. Yes or no? Because expenditure increase, decrease by 10,000. Depreciation was have debited to your P&L. Now that was not correct. We need to eliminate that effect. So 2,000 is your depreciation, which is reversed. So when the expenditure reduces, your profit will increase. So the profit will increase by 2,000. So this adjustment you can also write as one net effect, that is decrease by 8,000. One net effect. This was the second entry. Next, traveling expenses of 3,000 of Able for a pleasure trip to UK paid by the firm on 30th June has been debited to traveling expense. Again, an item of expenditure which is in the nature of drawings has been recorded as traveling expense. So drawing should be recorded and which is debited to travel expense need to be eliminated. So what will be the entry? Drawings account debit to traveling expenses. So what is the amount? 3,000. Now traveling expenses would have been debited in P&L. That was not correct. Now this effect is reversed. So your expenditure has come down. If expenses has come down, the profit would increase. So increase in profit by 3000. So this is what the entries were given with respect to rectification, which we have addressed. So let's find out the net impact on profit. There is an increase 750 minus 10,000 plus 2,000 plus 3,000. So there is in decrease of profit by 4,250 because it is in negative. Decrease in net profit. Now remember, with respect to last entry, this was also drawings of of able. We will add plus 3,000 plus 3,000 to able. Clear with this? Now we have to just do calculations of interest on capital and drawings. So first let's take the revised net profit or revised corrected profit. How much was given in the question? The draft showed a net profit of 60,000. Now this 60,000 we will have to reduce rectification impact 4,250. So this will be 55,750, which needs to be used for apportionment. This is my P&L appropriation by net profit carried brought down 55,750. So this is as per working note. Next, they have asked interest on capital to interest on capital, weak, able and lazy. Weak, what is the capital balance? Remember carefully, the year is ending on 31st December. Capital balance is given on 1st of Jan. So there is no months consideration here. Full year, we need to charge interest on capital. Interest on capital rate is given at 10% per annum. 75,000 into 10%, 7,500 for week. 40,000 into 10%, 4,000 for able, and 30,000 into 10%, 3,000 for lazy. 4,000 plus 3,000. Total interest on capital is 14,500. Next, there is interest on drawings. Remember, interest on drawings is an income to the firm. So it appears on the credit side by interest on drawings. Have they mentioned about any method here? Weak, able and lazy. Have they mentioned about any method? If no method mentioned, we will just work out on simple method basis. So here if you observe, have they given any number of months? No. So then we will just take the average period. Average period, if nothing mentioned, we will take it as 6 months. So let's calculate by working note here. So working note number 1. Working note number 2, interest on drawings. Weak, able and lazy. Drawings for week, if you observe, given was 15,000. Due to rectification, we are supposed to add those treated as drawings. So plus 750, 10,000 and 10,000. For able also, there was 3,000 extra shown as drawings. So amount of drawings will be 15,750. 13,000 and 10,000. So as we discussed, rate of interest is given, no period mentioned. So we will work out on average basis. Interest on drawings will be charged at 8% per annum. So interest on drawings 15,750 into 8 by 100 into 6 by 12. So this will be 13,000 into 8 by 100 into 6 by 12. 10,000 into 8 by 100 into 6 by 12. So this was 8%, right? Interest on drawings, just to confirm once. Yes. So let's calculate 15,750 into 8% into 6 by 12. So this will be 630. 13,000 into 8% into 6 by 12, 520. 10,000 into 8% into 6 by 12, 400. So 630, 520 and 400. 630, 520 and 400. This is working note number 2. 630 plus 520 plus 400 will be 1,550. Let's find out how much is the profit available for distribution. 1,550 plus 55,750. This is 57,300. 57,300 minus 14,500. 42,800. In this question, they have maintained current account. So we will transfer it to partner's current account. To partner's current account. Weak, able, and then lazy. 2:1:1 is the ratio. 42,800 into 2 divided by 4. 21,400. 42,800 into 1 divided by 4, 10,700 and 10,700. In this question, they have asked us to prepare P&L appropriation and also current accounts. So let's quickly do the current account. Depending upon what balances they have given in the question, we will have to bring it down. So this will be particulars, weak, able, and lazy. Particulars, weak, able, and lazy. Particulars, weak, able, lazy. So let's bring down the balances. Current account, what balance is given for weak and able? It is credit balance itself because nothing mentioned, 10,000, 5,000. Whereas for lazy, there is a debit balance. So by balance brought down 10,000, 5,000, and then to balance brought down 5,000. So here what we have done, we have just brought down the balances. Now let's consider the impact of calculations, whatever we have done in P&L appropriation. See, in P&L appropriation, interest on capital is debited. So this interest on capital also will be reflected in the current account, because in capital account, when it is maintained on fixed capital basis, no other entries will happen with respect to interest calculation. So here, by P&L appropriation account. P&L appropriation to interest on capital means by P&L appropriation. So by interest on capital, since interest on capital is an income to the partners, their balances will increase. So on that logic also, it comes on the credit side. 7,500, 4,000, 3,000. 7,500, 4,000, 3,000. Next, interest on drawings is an expense from the partner's point of view. So it comes on the debit side. 2 interest on drawings, 630, 520, 400. 630, 520, 400. 2 interest on drawings. This is done. Then there are drawings which we also have to consider with respect to current account balances. So interest similarly the balance is withdrawn, so therefore 2 drawings for week 15, 750, 13,000 and 10,000. To interest on drawings, and then ultimately the transfer of profit by P&L appropriation 21,400, 10,700, 10,700. 21,400, 10,700, 10,700 by P&L appropriation transfer of profit. So we have entered all the balances. For lazy, debit side would be more. 15,400, 15,400 minus 3,000 minus 10,700, that is 1,700. 5,000 plus 4,000, 10,700 is 19,700 for able, minus 13,000 minus 520, 6,180. 10,000 plus 7,500 plus 21,400, 38,900. 38,900 minus 15,750 minus 630, 22,520. So 2 balance carried down by balance carried down. So same balances will be brought down for the current account balances next year. I hope this question was understood to each one of you. It's a very interesting question and a good one to practice before exams. Make sure you follow the steps properly. First, we need to rectify, consider the impact on the net profit, take that profit for P&L appropriation calculation. Is this clear to all of you? Yes. Moving on to the last question. Ram and Rahim are in partnership, sharing profits and losses in the ratio of 3:2. As Ram, on account of his advancing years, feels he cannot work as hard as before, the chief clerk of the firm, Ratan, is admitted as a partner. That means what it feels is one of the partner who was existing there, he feels that he's not working enough with respect to the main role of the firm. So Ratan is admitted as a partner with effect from 1st of Jan and becomes entitled to 1/10 of the net profits and nothing else. The mutual ratio between Ram and Rahim remain unaltered. That is, whatever was the ratio 3:2, it continues even after the admission of Ratan. Before becoming a partner, Ratan was getting a salary of 500 per month together with a commission of 4% on the net profit after is the word to observe here, deducting his salary and commission. It is provided in the partnership deed that the share of Ratan's profits as a partner in excess of the amount to which he would have been entitled if he had continued as the chief clerk should be taken out of Ram's share of profit. Understand the wordings carefully. So here they are basically indicating about the guarantee of profit. That is, we need to first compare what is the share of profit available to Ratan from the details given. Then consider what was his remuneration if he was acting as a chief clerk, and then find out if there is any deficiency. The net profit for the year ended 31st December is 1,10,000. Show the distribution of net profit amongst the partners. So the net profit is given. So first we need to focus on what is available to Ratan. Ratan's share of profit. So this is available only if he is acting as in the capacity of partner. So he is entitled to 1/10 of the net profit and nothing else. What is the net profit given? 1,10,000. So in this 1/10 would be 1,10,000 divided by 10. So this is 11,000. Correct? Next. Yes. So we have calculated Ratan's share of profit as in the course of partner. So next will be Ratan's remuneration if he was acting as chief clerk. So first for salary, how much is taken as salary? He was admitted as a partner with effect from 1st Jan. So then to December, what is the per month salary? He was getting a salary of 500 per month. So 500 into 12 months. This will be 6,000. Then commission is given. So commission is mentioned that net profits after deducting his salary and commission. So what was the net profit? 1,10,000. What is the salary? 6,000. Commission we are supposed to find. But here when we are considering the rate, we will have to take after charging. That means rate divided by 100 plus rate. So this will be 1,10,000 minus 6,000. 1,04,000 into 4 divided by 104. This will be 4,000. So total is 10,000. So if you consider what is excess 1,000. So this needs is guaranteed by whom? This is being taken by Ram's share of profit. Let's again read the lines. It is provided in the partnership deed that the share of Ratan's profit as a partner in excess of the amount which he would be entitled if he had continued as the chief clerk should be taken out of Ram's share of profit. So what is this impacting here is, since Ratan, who was acting as a clerk earlier, now getting his status as a partner is definitely impacting the partner's profit or loss. So this is nothing but excess amount for which he is acting as a partner. Now this excess has to be taken from whom? Ram. Ram is ready to guarantee this. So what we need to suppose to do, prepare this in the P&L appropriation account. Appropriation account for the year ended 31st December, I guess 2022. Yeah. So by net profit brought down, the net profit was 1,10,000 to transfer to partners capital. There were 3 partners, Ram, Rahim and then Ratan. Ratan was first apportioned with 1,000 extra. Why? Because that is being given from whom? Ram's share. Provided to Ratan 1,000 provided to Ratan. So Ratan was getting 10,000 as part of his salary plus transfer from Ram 1,000. So he would ultimately get 11,000 as his share. So the balance left from 1,10,000 by transferring 10,000 to Ratan will be 1 lakh, which will be provided to Ram and Rahim in the ratio of 3:2. So into 3 by 5. So this will be 60,000 and then 40,000 to Rahim. So ultimately, Ram will be getting 59, Rahim 40,000 and Ratan 11,000. So this will be apportioned to partners' capital. This is how the profits will be transferred, which is the requirement of the question. So this question helps us revise two concepts. One is with respect to the commission, how to calculate commission, and then guarantee of profits. So please revise such question, guys. Whatever we have solved today is an important set of practice, because if you observe in the recent examinations, institute is testing at least for minimum 4 to 5 marks from this unit 1. So these were good set of practice of questions. Make sure you're not missing this before you appear with respect to your revision. Please keep practicing more and more so that you will also maintain that speed, which becomes most important trait in your examination hall, guys. Until I see you next time, keep working hard, give your best efforts. Take care, guys. See you soon in the next video.